In this video, we're going to explore why inequality doesn't behave the way we were told it would, why growth alone doesn't solve it, why wealth keeps concentrating, even in democratic, market-based economies, and how one economist changed the conversation by doing something deceptively simple. He looked further back than everyone else. This is the story of Thomas Piketty and what happens when you follow the data long enough that comforting explanations stop working. For most of modern history, inequality was treated like background noise. Unpleasant, sometimes worrying, but ultimately natural. Something markets would smooth out. Something growth would take care of. Something not worth focusing on as long as the economy kept expanding. The assumption was simple. If the economy grows, everyone benefits eventually. Maybe not equally, maybe not immediately, but over time, the system would balance itself. Then one economist disrupted that assumption, not with ideology, not with theory, but with patience. Instead of analyzing short time frames, he extended the lens. Not years, not decades, centuries. Welcome to the financial historian's perspective, where money, power, and time intersect, and where the stories we tell ourselves often collapse under the weight of long-term evidence. This is not a story about left versus right. It's not a moral argument. It's a mechanical one. It's about what the numbers say when you stop cherry-picking favorable periods and let history speak in full sentences. For much of the 20th century, mainstream economics focused on efficiency, output, productivity, and growth. The dominant belief was that a growing pie would eventually give everyone a larger slice. Inequality, if it appeared, was framed as temporary, a side effect of development or a statistical artifact that would fade with time, and for a while, history seemed to confirm that belief. After World War II, inequality dropped sharply across Europe and the United States. Wages rose, middle classes expanded, home ownership increased, wealth concentration declined. Economists looked at this period and quietly assumed they were observing capitalism in its mature, stable form working as intended, but that conclusion relied on an extremely short memory. Piketty's insight wasn't philosophical, it was archival. He didn't start with theories. He started with records, tax data, income statistics, national accounts, government archives, not from one country, not from one era, but across multiple nations, stretching back hundreds of years. And when he assembled that data into a continuous historical record, a very different picture emerged. The post-war era wasn't the rule, it was the exception. For most of modern history, wealth was far more concentrated than modern economics like to acknowledge. The 19th century, often romanticized as an age of opportunity and progress, was dominated by inherited wealth. Economic life revolved around ownership, not work. Capital mattered far more than labor. The sharp decline in inequality after 1914 didn't happen because markets suddenly became fairer. It happened because capital was hit hard. Wars destroyed fortunes. Inflation erased debts. Governments raised taxes dramatically. States intervened on an unprecedented scale. Equality didn't arrive peacefully, it arrived violently. And once those forces faded, inequality began doing what it had always done before. It started rising again. This led Piketty to ask a deeply uncomfortable question, not morally, but mechanically. Why does wealth tend to concentrate over time, even in democratic market economies? To answer that, he made a distinction that seems obvious in hindsight, but changes everything once you fully absorb it. He separated labor from capital. Labor is income earned by working. Wages, salaries, time-bound effort. It has limits. You can only work so many hours. Productivity grows slowly. Capital, on the other hand, is what you own. Assets that generate income simply by existing. Land, housing, stocks, businesses, bonds. Capital doesn't get tired. It doesn't negotiate. It doesn't need to show up. It compounds. This is where Piketty introduced the idea that would define his work, often simplified, often misunderstood. When the average return on capital consistently exceeds the growth rate of the economy, Wealth accumulated in the past grows faster than income earned in the present. It sounds technical, but the logic is straightforward. If you already own assets, your wealth tends to grow faster than the economy itself. If you don't, you're trying to catch something that's moving away from you. This isn't a conspiracy, it's arithmetic. And over long periods of time, arithmetic wins. Piketty showed that this pattern wasn't theoretical. It appeared repeatedly across countries and centuries. Before the 20th century, inherited wealth dominated economic life. After wars and policy shocks, inequality fell. Then, as growth slowed and capital recovered, the old pattern returned. The data didn't suggest a temporary malfunction. It suggested a tendency. That's why Capital in the 21st Century landed with such force when it was published in 2013. It quietly challenged one of the most comfortable assumptions in modern society, that inequality is mainly about effort, talent, or merit, and that markets naturally reward contribution over ownership. Piketty wasn't arguing that markets don't create wealth. He was showing that markets are extremely effective at preserving and amplifying existing wealth, especially when growth is low. When growth is high, wages and capital can rise together. When growth slows, capital keeps compounding, and labor falls behind. This is where the consequences become visible. Rising housing prices reward owners, not renters. Stock market gains benefit those already invested. Inheritance becomes more decisive as returns compound faster than incomes. Opportunity starts to depend less on talent and more on timing. Specifically, whether you gained access to assets before they became expensive. Compound interest doesn't care how hard you work. This is also why Piketty unsettled people across the spectrum. Critics argued that he underestimated innovation, entrepreneurship, and mobility. Surely new technologies would disrupt old fortunes. Sometimes they do, but Piketty's point wasn't that mobility doesn't exist. It was that, at the system level, it doesn't neutralize compounding. Exceptional stories don't define average outcomes. Supporters saw something else. A long-term map of how money and power interact and how misleading short windows can be. If you only study the post-war boom, inequality looks solved. If you zoom out, it looks structural. And that's where the real value of his work lies. Not in the policy debates, but in the perspective it forces. Zoom out far enough, and inequality stops looking like individual failure. It starts looking like a feature of how capital behaves when left uninterrupted. What made Piketty's work explosive wasn't just what it showed, but when it showed it. By the early 2010s, asset prices were soaring, wages were stagnating, central banks had flooded markets with liquidity, yet the dominant narrative still insisted the system was fair. Piketty didn't attack that story directly. He simply extended the timeline, and that's where the discomfort began. Because when you zoom out, patterns emerge that short-term narratives conveniently hide. Long periods of equality are rare. Wealth concentration is recurring. And the forces that reduce inequality historically are not gentle market adjustments. They are shocks. Wars, inflation, heavy taxation, political rupture. Equality didn't fall because capitalism matured. It fell because capital was disrupted. That reframing forces harder questions. Who benefits when asset prices rise faster than wages? Who gains when growth slows, but capital returns stay high? Who is protected and who is exposed when compounding does its work? Piketty never claimed to have simple answers. What he offered was a diagnosis, a long-term X-ray of how money behaves when it accumulates. And once you understand that, many modern phenomena suddenly make sense. Why housing feels unattainable even during growth. Why stock market booms coexist with stagnant wages. Why inheritance matters more than income. Why financial security increasingly depends on asset exposure, not career progression. In a low-growth world, capital doesn't need many opportunities. It just needs time. This is also why inflation plays such a complex role. Inflation erodes cash and wages faster than it erodes assets. When asset prices rise alongside inflation, inequality can widen even as policymakers claim success. the system isn't broken in these moments. It's functioning exactly as designed. And that's why misunderstanding this dynamic is dangerous. Piketty's work is often reduced to a moral argument that misses the point. His real contribution was showing that inequality persists unless something actively counteracts it. Markets don't naturally distribute outcomes evenly over time. They distribute returns to ownership. Understanding that doesn't force a political stance, but it does change how you interpret risk, opportunity, and security. Because if you mistake a structural tendency for a temporary phase, you don't just misunderstand history, you misunderstand risk. History doesn't repeat, but capital has habits, and one of its strongest habits is accumulation left uninterrupted. Wealth tends to gather where it already exists. Piketty didn't argue this was morally inevitable. He showed it was mechanically likely. Interruptions can happen, policies can change, shocks can reshape outcomes, but none of that happens by accident, and none of it happens because markets feel generous. That's the insight this episode leaves you with. Understanding inequality isn't about resentment, it's about realism, because seeing the system clearly is the first step to navigating it without illusions.